is preparation of final accounts of a company. Company's accounts, you see, whether it is a small company or a big company, they are to be audited by a chartered accountant. Now, books of accounts which are to be maintained by a company are, you see, they must be kept at the registered office. You see, whenever a company is formed, private limited company, two persons can form a private limited company, and minimum share capital is 1 lakh. If they contribute 1 lakh rupees, and they have to first search a name, and if that name is vacant, they have to apply to registrar of companies. In each state, there is registrar of companies office. In that, they have to apply when they form a company. And if that name is vacant, ROC tells them, yes, you go ahead. Then you see they should have 1 lakh rupees to start the company, and they will have to, you see, give to ROC one registered office address. That registered office, you see, where the company's registered office will be there, that address should be there with ROC, because whenever ROC wants to write anything, it will, you see, it will address at that, you see, place. And company can have any number of branches, you see, but the registered office will be, you see, same registered office will be there. Suppose registered office in Delhi, so they will apply for forming a company in registrar of company's office at Delhi. Suppose registered office is at Lucknow, so they will apply for forming the company at ROC at Lucknow. So once, if this registered office is informed to the ROC, then they have to prepare memorandum, and they have to prepare articles, and then they have to, you see, write to the ROC, submit to the ROC. Then ROC gives them permission that your company is formed, and you see, then they have to apply for the PAN number. They will get PAN number. Then from ROC letter and PAN number, they can open a, you see, bank account. So why I am telling this is, you see, about registered office. So company may have any number of branches, say all over India, they will have branches, but their registered office will be, you see, suppose they have been given permission from Delhi, so registered office is at Delhi. Now, books of accounts, you see, are kept at the registered office. Then it reflects a true and fair value of company's state of affairs. You see, company's balance sheet, company's profit and loss account, company's, you see, cash flow statement, maintained on accrual basis using the double entry system. Now, what do we mean by accrual basis? Accrual basis means, suppose our financial year is 1st, you see, April to next year 31st March. So whatever, you see, the expenses are, those expenses should be of this period, and whatever, you see, incomes are, they should be of this period. That is, you see, accrual basis. Suppose you have paid rent in advance, but you have to, in expenses, you have to take into account only the rent which pertains to this period. Similarly, some incomes, you see, you have received in advance, so you have to take those incomes which pertains to this financial year. And double entry system, every debit there is a credit. Suppose company has paid rent 20,000 rupees for the month of March, so they will credit their bank account. The bookkeeping, the entry, journal entry will be, they will credit the bank account, and they will debit the rent account. Rent is the expense. Now, annual general meeting requirements. As per section 129, financial statements must be presented by the board of directors. Now, every company has to conduct annual general meeting, that is AGM. Now, 31st March, then the company prepares the balance sheet, and then after preparing the balance sheets, all the directors, suppose it is a private limited company, there will be only 2 directors, minimum 2 directors. So they will conduct a, you see, AGM at the registered office of the company, and there they will, you see, pass these accounts which their accounts department has prepared. And once they pass these, you see, accounts in the AGM, then these are, you see, signed by the chartered accountant. The company's accounts are to be signed by the chartered accountant, even if the sale is less. You see, the criteria is even if the company is going in loss, profit. You see, company's accounts are to be audited. They are signed by the balance sheet is signed by the chartered accountant. Profit and loss account is to be signed by the chartered accountant. Then after the AGM, when the you see now CA has also audited the accounts and he has put his signature. Now all these statements are to be submitted to the registrar of companies. They are to be filed with the registrar of companies within 1 month of the AGM. Suppose the AGM is on 5th October, so they have to file it by 5th November, all these statements. We come to the next slide. Now, financial statements include profit and loss account, you see, and balance sheet. Balance sheet on the right hand side are, you see, assets. On the left hand side are, you see, liabilities. Then cash flow statement during the year, from where the cash came and how it was utilized, how it came and how it was utilized. Then statement of changes in equity shares, you see, share capital in the beginning, share capital in the end of the year. Then you see if there are notes to the accounts. Now, cash flow statement is not required for 1% companies. You see, sometime back, this registrar of companies, they allowed one man also to form a company, and that is known as 1% company. Otherwise, minimum 2 directors, you see, 2 persons are there to form a private company. And public limited company, you see, suppose Reliance has come out with one company, so they will give the advertisement in the newspaper for the shares. So whosoever will apply, then those persons will be allotted the shares. Then Reliance will collect application money, and after that, you see, this company will start, you see, functioning. So many of that public limited company, there are many owners, many shareholders will be there. But in you see, private limited company, minimum 2, and then this 1% company means 1% can only start the company. That is known as OPC. Now we come to the next slide. Now, Schedule 3 of the Companies Act 2013, the companies must prepare and present their final accounts as per Schedule 3 of the Companies Act 2013. Several new features of the schedule are, you see, vertical format of presenting the balance sheet. You see, it should be in the vertical format, balance sheet items, and their classification into current and non-current heads. You see, current assets, non-current assets, current liabilities, non-current liabilities, and capital on the liability side. Now, vertical format of profit and loss statement with classification of expenses based on nature. You see, expenses will be, you see, listed as per their nature of expenses, and the format will be, you see, vertical profit and loss account in the vertical form. Then accounting this cash flow statement as per accounting standard 3. Elimination of the concepts of schedule, and such information is now furnished in notes to accounts. So below the balance sheet, notes to accounts are there. So all such information is there in notes to account. It does not contain any specific disclosure for items included in schedule, you see, 6 under the head miscellaneous expenditure. Miscellaneous expenditure, you see, is so many expenses are there, you see, miscellaneous type of, you see, expenses. Now, say for example, traveling expenses, rent expenses, you see, freight, carriage, there are so many, you see, expenses are there. And those expenses in which, you see, we are not having a separate account, we put them in, you see, miscellaneous expenditure. Now, debit balance of profit and loss account, suppose the company is running in loss, will be disclosed as negative figure under reserves and surplus. If it is profit, it will be, you see, a positive figure. If it is a loss, it will be negative, you see, a figure. The schedule gives the prominence to accounting standard in case of any conflict between accounting standard and a schedule. Then we'll go as per the accounting standard. Now, profit and loss account, part 2 of schedule 3, you see. Now they have explained here. Revenue from operations, you see. Now, whenever we give this profit and loss statement and balance sheet, we, along with, you see, this year, our reporting, our reporting year, previous year also, you see, we give the figures so that, you see, we can readily compare, you see, what is the progress. Now, figures as at the end of current reporting period, say, now let us talk of 31st March 2024. So, fourth column will be of 31st March 2023. The first is revenue from operations. You see, how much money did you get? You receive from, you see, the activity, from the activity. Say sales, you can say it's sales. Then other income, if there is any other income that is to be, you see, included here. This is our total revenue. You see, one revenue from operations, sales plus other income. This is our total revenue. Now we come on expenses. You see, cost of materials consumed, purchase of stock in trade, changes in inventory of finished goods, work in progress, and stock in, you see, trade. What were the figures, you see, in the beginning? What are the figures in the end? So in between, whatever is the difference that is used, consumed this year, the employee benefit expense, if there is, see, some staff benevolent scheme or any, you see, expenses occurred on, you see, for employees, that we have to, you see, include here. Then finance costs, you see, bank charges, chartered accountant, you see, charges, etc. Then depreciation and amortization expense. Depreciation, you see, all furniture and fixture is to be, you see, depreciated, computers, machineries. Then other, you see, expenses. Those, you see, again, like miscellaneous, you see, expenses. So whatever are the other expenses, we will, you see, put it here. And then we get, you see, total expenses we get. And from total revenue, if we deduct total expenses, we get, you see, profit. So far, we have not paid the tax. From this, if we pay the tax, then we get, you see, profit after tax. Earlier profit was profit, you see, before tax. Now, balance sheet, part 1 of the schedule 3, you see, assets, whatever the company is owning, they are assets. And whatever companies owing, those are, you see, liabilities. So assets are the resources controlled by the enterprise due to past events from which future, you see, benefits are expected to flow to the enterprise. Liabilities are the obligation of an enterprise, you see, arising from the past event, the settlement of which leads to an outflow of resources, you see, embodying economic benefits. Now, equity is the residual interest in the interest of an enterprise after deducting all liabilities. From assets, you see, if we deduct all liabilities, we get the capital. Now, they have given the format of, you see, balance sheets. Here, same way, you see, this reporting period and previous, you see, reporting period, say 31st March 2024, 31st March 2023. So equity and liabilities, you see, we get here shareholder funds, you see, share capital, you see, then reserves and surplus, you see, every year, whatever is the reserve, they, you see, take out separately, you see, keep it separately. Then money received against share warrants, if any money is received against share warrants, that is there. Then share application money pending allotment, we have received the share application money, but we have not allotted the shares. Then now we come on non-current liabilities, you see. These were, you see, the first is equity And liabilities, you see shareholder funds. First is shareholder funds. Second is share application money pending allotment. Third is non-current liabilities. Those liabilities are long term. Suppose you have taken from a financial institution loan for 10 years. It is a non-current liability. You have borrowed money from the bank for a machinery which is repayable in 7 years. That is also non-current liability. You have taken car loan from the bank repayable in 5 years. That is also non-current liability. All those borrowings will come here. Now, long-term borrowings, then deferred tax liabilities. If there are other long-term liabilities, then long-term provisions. If you have made long-term provisions, those provisions will also come here. So these are all non-current liabilities. Next is current liabilities. Current liabilities means short-term borrowings. Suppose if we are having a cash credit limit from the bank. So this is our current liability. What is cash credit limit from the bank? You see, by seeing the past audited balance sheets, bank works out the credit requirements of the customer. Suppose past 3 years, and future this particular year, the company has projected that in this particular year our sales are going to be 1 crore rupees. So bank can give the company 20 lakhs working capital funds. Now working capital funds mostly they are given in the form of cash credit limit. Bank will open a cash credit account and mark 20 lakhs limit in that. And then in this account, customer will deposit the proceeds of the sales. Whenever customer will make purchases, raw material, etc., labor payment, rent, they will issue checks from this account. So at any point of time, the balance in the account should not go more than 20 lakhs limit. So this is CC limit. Why banks give this? Whenever customer is needing the money, he will use. So he will be charged interest only for that period. If he is not needing it, he will not use it. So this is current liability. Then similarly, overdraft. Suppose the customer has taken overdraft against his FD. He is having FD of 5 lakhs and he has taken 4.50 lakhs OD. This is also current liability. So short-term borrowings, trade payables, bills payable are there. Then other current liabilities, if other current liabilities are there. Then short-term provisions, if provisions are there for the short period, they will come here. So now we add all these, we get the total. Now we come on the asset side. So first is non-current assets and second is current assets. So under non-current assets, what will come? Property, plant and equipment, and intangible asset. Number one is property, plant and equipment. This is not a current asset, so it is a non-current asset. Then intangible assets like goodwill, goodwill is there. Then capital work in progress. Then intangible assets under development. And next is non-current investments. Then deferred tax assets. Then long-term loans and advances. Loans and advances given. Other non-current assets. So these all will come under non-current assets. Our current assets are current stocks, current inventories, then current investments, then inventories, then bills receivable, trade receivable, cash and cash equivalent, then short-term loans. We have given loans and advances for short period. So they will all come under current assets. Then other, besides this, if there are other current assets that we have to mention here. and then we'll total. So total of assets and liabilities will be same. So this is about our balance sheet. Next is, you see, share capital. For each class of share capital, you see the number and amount of shares authorized. You see, companies is authorized to issue so much, you see, so many shares. The number of shares which are issued, you see, how many out of that, how many are issued, subscribed and fully paid, and which are issued, subscribed but not fully paid. Suppose few shares are remaining, they are not fully paid. First call has come, second call has not come. The par value per share. What is the, you see, value of the share? Shares outstanding at the beginning and at the end of the reporting period should be reconciled. You see, this account should be reconciled. Then calls unpaid. You ask the money from the customers for the payment of the call, but they did not pay. Then forfeited shares. What do we mean by forfeited shares? You see, we have received the application money. Then we have allotted the shares, and then we have received allotment money also. We have not received first call money. We have not received second call money. Or we have received one first call money, but second call money we have not received. So for such shares, we give notice to the, you see, customers that by such and such date, you have to, you see, pay the balance amount. If you will not pay, we will forfeit your shares. So company forfeits those shares, and then company can issue those shares to other people. So this is forfeited shares. Now we come on the next. Reserves and surplus. Now capital reserves. Then capital redemption, you see, reserves. Securities premium, debenture redemption reserve, revaluation reserve, surplus, the balance as per profit and loss, you see, statement. Then next is, you see, other reserves. Now long-term borrowings. Suppose, you see, company has, you see, long-term borrowings can be classified under bonds. Company has issued bonds, debentures. Then company has taken, you see, term loans from financial institutions, banks. Then liabilities are deferred payment liabilities. Then company has taken deposits from the people. Now why people will, you see, invest in the company? Because company may give them some, you see, 0.25% more interest. Then long-term maturities of finance lease obligations, you see. Then loans and advances from related parties. If company has borrowed from friends and relatives, loans, advances. Other, you see, there are other loans and advances. So these are all long-term borrowings, you see, which come under, you see, non-current liability. The next is long-term provisions. You see what provisions we have made. These are employee benefits provision, like gratuity. You see, we have, when a person retires, we have to give him gratuity. We have to give him provident fund. Then other provisions, if there are other provisions also. Now next is, you see, short-term borrowing. Short-term borrowings, loans repayable on demand. Suppose demand loan, you see, they have made demand loans. They have obtained demand loans. Loans and advances from related parties. Related parties, anytime they can ask back their money. Then deposits, other loans and advances. If they are there, we have to specify. Then other current, you see, liabilities. Interest accrued but not due, but not and due on borrowings, you see. Then if we have received any income in advance which does not pertain to this period, so it is our liability. So the dividends which are not paid, that is also our liability, current liability. We have to pay them immediately. Application money received for allotment of securities and due for refund and accrued, you see, an interest accrued on thereon. Suppose we have to return the application money with interest. This is also our current liability. The next is other current liabilities. If other current liabilities are there, we have to mention them here. Now next is, you see, assets, tangible assets. We can get money immediately if we sell them. Land, buildings, you see, plant and equipment, furniture and fixture, then cars, motorcycles, vehicles, then office equipment, computers, etc. Others we have to specify here, you see. Next is intangible assets, which are not tangible, can't get cash immediately, like goodwill, you see, brands and trademarks, some software if you have developed computer software, mining rights, publishing titles, copyrights, patents and other intellectual property rights, services and operating, you see, rights. These are all intangible assets. We can't get money immediately. License and franchise, then recipes, models, designs, formulae, and prototypes. Next is our non-current investments. Now, investment in property, you see, then investment in equity instruments, you see, shares, etc. Investment in preference shares, you see. Investment in government securities, or you see, trust securities. Then investment in debentures, if we have invested money in debentures or bonds. Investment in mutual funds, you see. If we have invested money in partnership firms. Other non-current investments, if we have invested the money somewhere else, so we have to specify here, which are of not current nature, if they are of non-current, you see, nature. Then now next is long-term loans and advances, you see, capital advances, security deposits, suppose we have given security deposits. Then loans and advances to related parties, you see, other loans and advances. The above shall also be subclassified. Secured, you see, where there is some, you see, security is there. Unsecured, you see, no security, but they are good. Doubtful, they may not come, they may come, they may not come, you see, they are doubtful. Current investments, now investments in equity instruments, then investments in preference shares, investments in government or trust securities, investment in bonds or debentures, again investment in mutual funds, investment in partnership firms, other investments if there are any. Next is our, you see, stocks, inventories, raw materials, work in progress, stores and spares, finished goods, loose tools, you see, stock and trade, goods in transit, you see, and if others, you see, then we have to specify them here. Now cash and cash equivalents, you see, balances with banks, then checks and drafts in hand, you see, in the company, checks and drafts, then cash in hand with the company. If other, you see, if there is anything else, we have to specify here. Next is, you see, cash flow statement, you see. The cash flow statement, you see, provides a detailed view of an enterprise, you see, cash flow position, identifying cash inflows and outflows, how that is used from operating activity, investing activity, and financing, you see, activity. Its purpose is to explain the movement of cash between, you see, 2 points in time. Sources of cash includes issuing of shares. We have issued the shares, we have received money, we have issued debentures, we have received money. We have raised long-term loans from financial institutions, banks, we have received money. And we have, you see, sold investments or fixed assets, we have received money. As well as, you see, cash is generated, you see, from operations, from our doing that, you see, activity. Conversely, the application of cash covers, you see, redemption of shares. When shares are redeemed, we have to give back the money, debentures. We have to pay the loan, you see. Then we have to purchase fixed assets or investments. So money goes for that. Payment of taxes, money goes. And payment of dividends, money goes. And covering net, you see, operating, you see, losses. Cash is defined to include cash in hand, demand deposits with banks, and short-term liquid investments or securities. But they should be for short term, with maturities of less than 3 months, you see, from the date of acquisition. So that we can take it into cash if they are matured within 3 months. Cash flow from, you see, operating activities for running the, you see, say, some factories there. So when we start this manufacturing, you see, suppose we are having a you see, small factory where we are manufacturing this plastic, you see, buckets. And for this, some, you see, raw material, say steel, some steel will be required, then plastic will be required, then some machinery should be there, heating arrangement, you see, and then we will be engaging labor also, you see. Now, when we start, you see, manufacturing these buckets, first of all, we will buy the raw material, then labor will be hired, and then we'll start the activity. Then we will sell these, you see, buckets, and those who buy, they also buy on, you see, credit. They will not give us the immediate, you see, payment for that. So right from the first day when we started, you see, manufacturing the bucket, and the day on which, you see, payments realized, suppose, you see, it takes 3 months. So that is our operating cycle. That is our operating cycle. So like that, if it is for 3 months, so in a year we will have, you see, 4 cycles, 4 operating, you see, cycles in a year we will have. Suppose our yearly sale is, you see, 100 lakhs, 100 lakhs our sale is there for 1 year. And this means in one operating cycle we are having sales of 25, you see, percent. So accordingly we can, you see, apply to the bank for getting the limits for getting the, you see, bank's funds. Now this was about, you see, operation activities. There are principal revenue generating activities of an enterprise. Positive cash flow from operating activities help on enterprise maintain its, you see, operating capability, pay dividends, repay loans, make new investments, etc. It also provides, you see, valuable information about financing through, you see, working capital. Now this, I told you about this 3 months, you see, operating cycle. Here, you see, the working capital which the, you see, company will be needing. Normally bank, you see, sanctions 20% of the sales. Suppose the company's sale is, you see, 1 crore. So bank will sanction working capital limits, you see, 20 lakhs. So again, it is sanctioned in the form of a CC limit. Whenever customer wants to, you see, make purchases, he will make purchases by issuing checks from that CC account. and whenever whatever are the sales of the customer, they are deposited in the account. So it is ongoing, you see, it will continue. So whenever customer is having, you see, money, he will deposit in that. Whenever customer is requiring money, he will, you see, withdraw from this account. So this is how banks, you see, finance working capital limits to the customer. So next is cash flow from investing activities. Suppose the customer is, you see, investing money. It deals with the acquisition and disposal of long-term assets. You see, you buy long-term, you buy assets or you dispose of assets and other investments. In other words, it represents the extent to which expenditures have been made for resources, you see, intended to generate future income and cash flows. So here, you see, money will, you see, go out. Cash flow from, you see, financing activities. There are activities that result in changes in the size and composition of owners and borrowed capital. These are useful in predicting claims on future cash flows by providers of capital to the, you see, entity. Examples include cash proceeds from the issue of equity shares, you see, cash received from loans, debentures, issuance of debentures, etc. So now this is, you see, cash flow from operating activities. You see, we have to start with the net profit. Net profit before taxation and extraordinary, you see, items. Now adjustments related to non-cash and non-operating items. You see, items to be added. In this profit, what is to be added? Depreciation on fixed assets. Then interest on, you see, borrowings. Then preliminary expenses, underwriting, commission, discount on issue of debentures, shares written off. This we have to add. Then goodwill, patents, trademarks, copyright, amortized. You see, that we have to add. Then loss, if there is loss on sale of any machinery, land, building, investments, etc., that loss amount we have to write. Then premium payable on redemption of preference shares. You see, if any premium is payable at the time of payment of, you see, preference shares or debentures, that we have to, you see, mention. So all these items are to be added in the net profit. And then what is to be, you see, reduced? Interest income, other income, that is to be reduced. Dividend income reduced. Discount on redemption of preference shares, debentures, that amount is to be reduced. Then profit on sale of machinery, land and building, investment sector, that is to be, you see, reduced. Now we get operating profit before working capital changes. This is our operating profit before working capital changes. Now adjustments related to changes in current assets and, you see, current liabilities. Now in this operating profit, we add decrease in current assets, increase in current liabilities. And from that, we again reduce increase in current assets and, you see, we reduce decrease in current liabilities. Now this is cash generated from operations. From this cash, we reduce income taxes paid, you see, we reduce that. We get cash before extraordinary, you see, items. From this, we reduce extraordinary items. We get net cash inflow, you see, from operating activities. Now next is, you see, cash flow from investing activities. You see, we have received money from sale of machinery. We have received money from sale of land and building. Received money, sale of furniture and fixture, sale of investments, sale of goodwill, patents, rights, trademarks, etc. So all, you see, we add all these things. In this, we add non-operating incomes for investments, dividend from shares, you see, we add interest received on debentures, we add, then rent on, you see, property received, that also we add. So now from this total, we reduce purchase of non-current assets, you see, like purchase of machinery, purchase of land, because from cash is going out by this. purchase of machinery, purchase of land and building, purchase of furniture and fixture, purchase of investments, purchase of goodwill, patents, rights, trademarks, etc. So after reducing these from the above, we get net cash flow from investing activities or net cash used in investing activities. Now third is, you see, cash flow from financing, you see, activities, you see. Now proceeds from issue of share capital and, you see, borrowings, proceeds from issue of equity shares, proceeds from, you see, issue of preference shares, proceeds from issue of debentures, etc. So all this, you see, money which we have received, we have added. From this, we have to reduce buyback of equity shares, then redemption of preference shares, redemption of, you see, debentures where money has gone, interim dividend on equity shares paid, you see, final dividends paid on equity shares, dividend on preference shares, then interest paid on debentures, etc. All these things, you see, we have to reduce. So we get, you see, net cash flow from financing activities or net cash used in financing activities. So there are three, you see, portions. First portion is, you see, cash flow from operating activities. Then here we start with, you see, net profit before taxation and extraordinary items. In this we add, you see, depreciation on fixed assets, interest on borrowings, preliminary expenses, underwriting commission, discount on issue of debentures, shares written off, etc. Then we further add goodwill, patents, trademark, copyright, amortized, you see. Then we add loss on sale of machinery, land and building investments, etc. Then we add premium payable on redemption of preference shares, debentures. The total which we get, we reduce from that total, you see, interest income, other income, dividend income, discount on redemption of preference shares, debentures, profit on sale of machinery, land, building, investments, etc. So we get operating profit before working capital changes. Now we will adjust working capital in this, you see. Adjustments related to change in current assets and current liabilities. You see, in this we will add decrease in current assets, we will add increase in current liabilities, and we will reduce increase in current assets, and we will reduce decrease in current liabilities. So we get cash generated from operations. From this we will, you see, reduce income taxes paid. Then we get cash before extraordinary items. From this we reduce extraordinary items. We get net cash inflow, outflow from operating activities. So next is our, you see, cash flow from investing activities. You see, when we invest money, proceeds from, you see, disposal of fixed assets, you see, proceeds from sale of machinery, then proceeds from sale of land and building, proceeds from, you see, sale of furniture and fixture, proceeds from sale of investments, then proceeds from sale of goodwill, patent, rights, trademarks, etc. So all these we add. From this we add further non-operating income and investments, dividend and shares, then interest received on debentures, rent on property received. You see, from this total we will be reducing, you see, purchase of machinery, amount spent in purchase of machinery, amount spent for purchase of land and building, amount spent for purchase of furniture and fixture, amount spent for purchase of investments, and amount spent for purchase of goodwill, patents, rights, trademarks, etc. So after these items, you see, reduction, we get net cash flow from investing activities or net cash used in investing activities. So our third part is, you see, cash flow from financing activities. So proceeds from issue of equity shares, whatever, you see, money we have got. Then proceeds from issue of preference shares. Then proceeds from issue of debentures. If we issue debentures, we'll get money. If we will issue preference shares, company will get money. If we'll issue equity shares, company will get money, you see. If we'll add all these items, so they are proceeds from issue of share capital and borrowings. Then from this we will, you see, reduce this buyback of equity shares. We will reduce redemption of, preference shares. We will reduce redemption of debentures. When debentures are redeemed, preference shares are redeemed, and buyback of equity shares. Then interim dividend on equity shares when we pay, final dividends paid on equity shares, dividend on preference shares, then interest paid on debentures, etc. All these items will reduce. Then we'll get, net cash flow from financing activities, net cash used in financing activities. So we have seen net cash flow from, financing activities or net cash used in financing activities. We have seen net cash flow from investing activities or net cash used in, investing activities. And we saw net cash flow outflow from operating, activities. Now we come on the next slide. That is, statement of change in equity, share capital. It is the reconciliation, between the opening and, closing balance of shareholders' equity, capital account. The statement summarizes the transactions related to the shareholders' equity over an accounting period. It is, normally from 1st April to 31st March of the next year. Now, in this particular year, this 31st March 2024, it started from 1st April 2023 to 31st March 2024. All these companies, they will prepare their, balance sheet, and individual, people, they paid their time limit for payment of taxes was up to 31st July. They had to file the income tax return. First, individuals, they file the return. Now, next will be, partnership firms and, these companies. And many partnership firms, those big partnership firms, they get their accounts, audited. And many are, where this audit of accounts, it depends on the turnover. Turnover means sales. If sales is more, then they have to get it audited and submit their balance sheet to the income tax department with the payment of taxes. Now this, for companies, they have to pay this, they have to file the income tax return by this 30th September. They have to file the income tax return. If any tax is due, they have to, pay the tax along with the interest. This income tax return they have to file. Now, it is the reconciliation between the opening and closing balance of shareholders' equity. The statement summarizes the transactions related to shareholders' equity over an accounting period. Accounting period is 1st April to 31st March of the next year. It records movement in related earnings, other reserves, and changes in share capital. Statement of, changes in equity is to be presented, and it includes reconciliation of the opening and closing balance of equity, describing changes in detail, details of comprehensive, income for the accounting period, then details of changes and the impact when components of, equity are, restated, then applied retrospectively, in accordance with the IAS and Indian AS, Accounting Standard 8. Then comprehensive income is the income listed under the net income on the income statement. So this was about, preparation of, final accounts of companies. We have seen here in this, they have explained about one-person company also, private limited company, public limited company, one-person company. So they have to refer to their, accounts in the AGM, when all the directors of the company are there and they have to sign the balance sheets and profit and loss account.
सर कोई छेड़ा था कुछ?
नहीं, कुछ गलत हो गया?
गलत हो गया बिल्कुल.
The transactions related to the shareholders' equity over an accounting period. It records movement in retained, you see, earnings, whatever are earlier years' profits, that is, which were retained in the business, other reserves, and other changes in, you see, share capital. If any fresh shares, you see, issued, statement of changes in equity is to be, you see, presented, and it includes, you see, reconciliation of the opening and closing balance of equity, describing the changes in, you see, details of comprehensive income for the accounting, you see, period, details of changes and the impact when components of equity are, you see, restated, applied retrospectively in accordance with the Indian Accounting Standard and Indian Accounting Standard 8. Comprehensive income is the income listed after the net income on the income statement. So, students, this was about statement of change in equity. So, in this particular lecture, we have, you see, studied about preparation of final accounts of a company. We have to prepare the profit and loss account. We have to prepare the balance sheet. We have to prepare the cash flow statement, and we have to prepare the statement of change in, you see, equity. So we are closing this video. Thank you very much, students. Thank you very much.